Let us analyze our eighth transaction. Rohan finds an investor, Rahim, enthusiastic about his ideas and willing to invest $50,000 cash for a 20% stake in the business. Rohan accepts Rahim as a business partner or shareholder and issues 200 shares in favor of Rahim and 800 shares in favor of him. We'll keep in mind that every accounting transaction follows the double entry system, where each transaction involves at least one debit and one credit entry. This system ensures that the accounting equation, assets equals to liabilities plus equity, remains in balance. In other words, the total debits must equal the total credits for every transaction. Since Rahim invests $50,000 in cash in the business, the assets in the form of cash will increase by $50,000. Let's remember here, increase in an asset account is a debit entry. At the same time, since this is an investment in the business in return of ownership in the business, the owner's equity will also increase by $50,000. We must also remember here that increase in owner's equity account is a credit entry, and there are no liabilities created for this transaction. The lesson from this transaction is a company has no legal obligation to pay back money received from stock investors. That's why it is recorded as owner's equity and not a liability. The stock investor becomes an owner of the business.